So, hi everyone, we are back to our course Indian Economy, some contemporary perspectives. Now, we are in the 21st lecture of this particular course and we were discussing the banking sector reforms. And in the banking sector reforms, we mostly focused on how we can go for revival of the banking sector. So, earlier it was just on the capacity expansion. So, we had focused on how we can go through those expansion processes, whatever was the objective of the government, how government undertook measures to target those economic plus socio-economic objectives. And because of that, we had to go for two phases of nationalization of banks, and then we focused in the post 91 era, where we had to go for two stages of economic banking sector reforms. And it was Narsimham Committee 1 and Narsimham Committee 2, and we had discussed in detail that what all changes banking sector had to incorporate and how they had to go through a structural change, in the sense that the banking sector had to adopt new changes in their functioning, plus also they had to diversify their activities, and government was also quite supportive in that direction. And that's why then we had the era in which we had the non-banking financial companies. Then we had the developmental financial institutions, how these institutions played important role in the beginning years, in the formative years when we had gone for the second 5-year plan, industrial revolution. And that industrial expansion was supported by the DFIs. But post 1991, we found that these DFIs had a lot of inefficiency issues in terms of higher NPAs and losses incurred due to protective environment. So, post 1991, some of the DFIs were converted into commercial banks, and commercial banks and as per the Narsimham Committee report, they were given opportunities for diversification and also engage in certain activities. So, most of the DFIs are almost now as in commercial banks. So, commercial banking arm was given to them. Then we also we also focused on how we had to open the space for the private sector. So, the government had a complete signal that there is no intention to go for another phase of nationalization of banks. So, that's why the private sector banks were given importance and licenses were issued by the RBI. RBI became the sole regulator as compared to the dual regulatory system. Under that, we had a particular division of Ministry of Finance regulating banks plus RBI. So, we had to go for the unified regulatory structure, and under that we had to give more power to RBI to manage the banking system in the country. And then we had also seen that how we had to go for the interest rate deregulation process, wherein we had gone for a rationalization of cash reserve ratio, statutory liquidity ratio, SLR ratios, bank rate, and even we also had to go through regulatory setup that would give us some idea about how we had to align our banking system with international standards. So, Basel I, Basel II, how these two regulatory frameworks helps our banking system to revive in the modern era. So, to face the global competitiveness, the government also allowed foreign banks, and the foreign banks also found it quite difficult, because in the regulatory space the nationalized banks were more given power and they had the more market share, but there was no discriminatory regulatory norms devised for separately for the public and private banks. So, all the banks are supposed to be follow the RBI guidelines, and that's why the Indian banking system thrived. And then there was at one point of time there was a regulatory issue of competitiveness, and then also the efficiency inefficiency. The banking system, the banking structure was also marred by the inefficiencies with regard to the non-performing assets because of the priority sector lending and less recovery. So, that led to over a period of time accumulation of NPAs. So, though the banking sector size was increasing, expanding every year, so the ratio was not high, but in terms of actual number it had gone up. So, during 1990 before 1990 or 1980s, we had the NPAs of less than 300 crore, but then after that it became more than 500, and subsequently we experienced a severe damage to the banking system in 2016 when we had to go for the structural changes again. In this particular lecture, we will be focusing on the recent developments also, and plus some changes that are linked partially to the banking sector, plus also to the finance sector. So, we will be seeing now the contemporary development. So, we will be now moving to focus on certain committees, reports. We will be also referring to economic surveys 2016-17, and then we will be moving gradually to the framework which we are living in, the banking regulations that we are facing. So, in terms of recent developments, we will be targeting that. So, this is what. So, for this particular lecture, I have referred this one very good document that I found about Mohan. This I referred in the last lecture also. Then Suri, Goyal remains same. Padmanabhan SG article is really good on the capital account convertibility, central bank's speeches. It is available on BIS. Then I found Patnaik and Shah reforming India's financial system. It is also some kind of walking paper, but this also gives a lot of ideas. But where it is linked, I will tell you in the later sections, and maybe in the coming after 5 to 10 minutes. The objective is same, to focus on the non-banking segments and regulations of the India's banking sector, financial sector regulations and recent developments, right. So, in India, in NBFCs were there for a very long time. So, if you remember, we were discussing about financial intermediaries at the time of independence. So, these were the money lenders and different form of aggregators, they were extending loans to the farmers and other peasants classes. But in 1990s, this was given an extraordinary importance, and it also led to the NBFC revolution in India. So, a task force was set up in 1998 to give a proper shape to the booming sector, and then at that time this particular sector reached to an extent that it became quite popular in not only in the urban setup, but in the semi-urban and the rural segment also. So, during 1990s and I would say late 1990s, there was whole lot of boost to the NBFC sector, and there was a mushrooming across the country in terms of opening up the new NBFCs. A lot of NBFCs became popular for their size and in terms of the reward and the kind of returns they were promising to the investors. But after that, it had a negative impact on the economy, because after 4 to 5 years in the beginning of 2000, most of the NBFC disappeared, and there was a consolidation of the NBFC industry. So, only the large shareholders were survived, and RBI also had to come up to regulate the NBFCs, because they had to design certain framework so that there should not be any spillover on the banking sector. So, RBI had set up SLR requirement higher than the banks, just to make sure that it does not lead to spillover or systemic risk spillover to banking sector. The number of NBFCs also increased 14,000 to 12,630 by 2010, and you must have read in newspaper in September 2018 how NBFC crisis led to the whole lot of debate and discussion on the survival of this particular sector, and also on the regulation of this particular sector. So, this particular topic we will be discussing later, maybe in the next session or next to next session. So, for the time being, we can say that the liberalization of the banking sector even the licensing given to the private sector. This also led to the development of the NBFC sector. NBFC provided a lot of liquidity to the financial system. It also had penetration to the semi and the rural segments, and that's why this NBFC nowadays it has become systemically important institution. Some of the NBFCs are now equivalent to the commercial banks and even have the size of the smaller public sector banks. Now, with this background, I think this is sufficient as of now to talk about the NBFCs. Now, in later years, we are now into the 2000 and 2010. So, maybe you can say before 2005 and after 2005. After 2005, we had a lot of developments. There was one recommendation by the Tarapur committee. It was about the capital account convertibility, because it was found that since the economy was opening up, we were having expanded financial sector, and at that point of time there was a lot of debate and discussion that whether we should be having a complete convertibility of rupee not only on current account but also on the capital account. Now, capital account becomes quite controversial topic, because it consists of the inflow and outflow of hot capital, which means that the foreign institutional investors, foreign portfolio investors will also be allowed, and the entity which are holding their wealth in terms of national currency, they will be allowed to convert in any form of currency. There are advantages and disadvantages of capital account convertibility. One advantage is that the transaction smoothing takes place, and because of that this may have a positive spillover on the trade, but another point of view is that the domestic currency becomes weak, and it may happen that it may not be relevant for the transactions, because the most popular currency may dominate over the domestic currency. And since the volume of transaction in rupee was really low, so just to make sure that rupee remains significant, or it should have some contributions, so capital account convertibility was not recommended by the Tarapur committee. It was a report was submitted in 1997, and this committee had recommended that unless India has a very strong macroeconomic fundamentals in terms of fiscal deficits, in terms of current account deficits, in terms of external commercial borrowings, in terms of the domestic inflation and all other parameters, then only it should go for capital account convertibility. Otherwise, it may have a speculative attack on the domestic currency and domestic currency may not be relevant. In December 2005, a high level committee on corporate bonds and securitization was so in India, unfortunately, corporate bond market is not well developed, and unlike government bond market, where we have a certain limitations on investment, so public sector banks and the insurance companies, pension funds are encouraged to invest or to buy the government securities. Open market operations are quite high liquidity, but unfortunately in India corporate bond market has not been developed, and that's why there was a committee set up in 2005 to look after whether there is a scope for having a separate channel for the corporate bond market, so that the companies will not only rely on the capital market or the stock market for their borrowing, they can also borrow through the bond market. And this committee had come up with lot of recommendations going through from not only from the liquidity side but also from the regulatory side. The report is available on the RBI website, and it is quite insightful. So, if you want, you can refer. In 2006 again, since the full capital account convertibility issue was not completely settled, so the Tarapur committee too had to give recommendations, and it gave recommendation in 2006. So, capital account convertibility, then in 2006 it was recommended that since the rupee is not one of the highly liquid currencies in the world, and the macroeconomic fundamentals are also not quite robust, and under FRBM Act, though there is a limit on the fiscal deficit, but government was not able to meet. There was also a requirement that unless those requirements are met, then only there will be full capital account convertibility. But the committee had also recommended some phases, that in not only in one phase, but all in 3 phases capital account convertibility should take place. And now there are some relaxations with regard to the non-residents Indians investing in capital market, with regard to the some qualified investors. So there are some relaxations, but it is not fully convertible as we see in the case of some other countries. Then in February 2007, there was a high powered committee also of making Mumbai as an international financial center, and this was this is also known as the Parsi Mistry Committee, and it also submitted the report. And this particular committee had entrusted the task to recommend or to make a recommendation, and these recommendations should be in a futuristic manner, so that in a more sustainable way Mumbai can become one of the global financial centers, and it can also attract the amount of investment as compared to what we see in case of BRICS and other countries. Then in 2007, Planning Commission had set up a very commendable committee that gave a recommendation on every aspect of the financial sector reforms, and it was called the Raghuram Rajan Committee report, and it was submitted to the Planning Commission. It is also called as Gen Next reforms in the case of financial sector, and this committee had recommendations touching each and every areas, even the area of financial inclusion. So in case of financial inclusion also, this particular committee is well known. So Tarapur 1 committee, at that time I have already discussed that there was some recommendations linked to the macroeconomic fundamentals of the Tarapur 1 committee, and this committee felt that until unless the inflation, the current account deficit, fiscal deficit targets are not met, it is not advisable to go for a capital account convertibility. And at that time India was not in that comfortable zone in terms of the forex reserves. So our forex reserves was not as high as we have right now. So at that time there were some apprehensions about the speculative attack on the India's exchange rate, and also in terms of going for high conversion of and there were also apprehensions that there will be high conversion of domestic assets into foreign assets, and foreign assets may not come may not come in the expected manner. So that's why this particular committee recommendation was on hold for the capital account convertibility. Then Indian government had also gone for enactment of Fiscal Responsibility and Budgetary Management Act, and this act also had put very stringent norms on the fiscal deficit. Right now it is 3%, at that time it was 3.5%. Tarapur 2 committee recommendations were quite useful, but this as I told that this committee had to go for recommending structural changes in the sphere of capital account convertibility. External commercial borrowings were put on check, and they were also allowed to a certain extent. The investments were also encouraged in a different form, not from the foreign portfolio investors or foreign qualified investors. If the foreign qualified investor is registered with the SEBI and if they follow each and every disclosure norms, then they were also allowed, but it happened in a phase wise manner. It didn't happen, but still we are not fully convertible. Capital account convertibility is still a concern. And at that point of time, one major concern was that in the international currency market, rupee is not one of the frequently traded currency. So at that time, keeping in mind the low liquidity in the Indian rupee, it was recommended that we should not go for the full account convertibility. Otherwise, whatever forex reserves that we have, we may have to spend the whole for just to manage the managed floating system that we have. So central bank will have to put extra effort and may not be able to manage the domestic indicators. So that's why it was recommended that it should have in a phase wise manner, that will be in 3 phases, 2006 and 2009, post 2000 and after post 2009 and after that. So this committee also did not give full scale recommendations, but there are certain limitations, certain recommendations were made in favor of the banks, in favor of the firms, so that they can expand their business activities. They can have some amount of borrowing and lending in not only rupee but in some other currencies, just to make sure that this does not hinder the developmental process. That so expansion of the banks and the firms were given opportunities. Then a high powered expert committee on making Mumbai an international financial center. It was Percy Mistry Committee 2007, and it has gone for the overall recommendation. So even finance minister at that time, we had P.C. Chidambaram. So at that time he had gone for appreciation of this particular report, but there was also certain regulations with regard to capital account convertibility. So that became one of the debated topics, but still it was recommended that since to make Mumbai as an international financial center, you require a high skilled labor force in the quantitative finance plus coding plus other skills. So it was required that there should be a special focus on the manpower who are going to be specialized in finance, and these people will be called as front office workers, and then there will be subordinates, and there will be one more linked or para financial accountants, and there will be also some kind of law or compliance related courses should be given more promotion, so that we will have sufficient capital to generate or to regulate or to operate not only the financial sector, but also in terms of product innovation, because financial sector is a quite diversified sector and quite innovative also. So we can go for, instead of following the global standard of having only the contractual or non-contractual kind of products, we can also have our own I would say proprietary products, not only in terms of quantitative finance, financial modeling, but also in terms of accounting and other standards. So this was required. There was also, since most of the ITES services, IT enabled services, are going to be having a headquarter or maybe a back office services available in India. So there should be a focus on higher connectivity, and it was also recommended that there will be a world class telecommunications infrastructure set up, so that there will be access of information round the clock, and there should not be any kind of hindrance with regard to the technology. There is also recommendation to set up a state of the art IT system to supplement this telecommunication sector. There was also a recommendation to have a highly liquid all segments of the financial sectors, which comprise equity, bond, then derivatives, and all other types of standard and substandard contracts, commodities, forex, all types of financial instruments, financial products should be available, and it should be quite diversified with the outreach of the even not only the Mumbai but outside Mumbai, Mumbai's masses. So this was the first of its kind committee recommendation. So I thought I should be mentioning here, so that you should be aware of that government has already set up such type of committees to look after. So here we have the Ministry of Finance high powered expert committee. It is the Mumbai and International Finance Center. You can have a look. It is available on the Ministry of Finance website. Then we had a Gen Next reform. It is also called as 100 small steps. So based on the request of Prime Minister Manmohan Singh, Raghuram Rajan had agreed to work on the financial sector reforms, and in 2007 he had given a gigantic process to help understand the Gen Next reforms, and this reform had given a lot of hope to the financial sector, because for the first time a committee had gone for such a elaborate recommendations on each and every components. Some of the recommendation I have added, but for your reference you can just have a look on this. The document is available at IIM Ahmedabad website, and you can access it there, and it has the whole lot of recommendations. For the first time this committee had recommended that RBI should have the single objective of just targeting the inflation, and it should target either on a single rate or in a band, so 4 ± 2, that we have, and if it has a target, then it can target in the medium term. The repo and reverse repo should be the main target for the, or it should be the policy rate, the targeted policy rate, and it should be in the hand of RBI based on the movements of inflation and the exchange rate management system they can decide about. The opening of the corporate and government bonds for foreign investors in rupees. So, just to promote the rupee, and so here you have the bonds are traded in two denominations. It depends, it can be traded in some other denominations also, but popularly one is called local currency unit and one is called US dollar. So, in case of local currency unit, so it was recommended that once we start selling the bonds to the foreign investors in terms of rupee, then rupee will have high liquidity, and this will again will have this will also will become popular after some point of time. Broadening the base of financial access, financial inclusion should be promoted by means of expanding access to financial services such as payments. Then we had saving products, insurance product, inflation protected pension funds. Entry to private firms were also encouraged. Even the alternative investments were encouraged by some way. The committee had recommended some alternative investments or some filter based investment strategies. For example, Sharia law, or it is called Islamic finance, can also come into, and this committee had given the recommendation that whatever form of financing we have, even in terms of community financing system, and if it is not very exploitative, then it should be promoted and it should come under the gambit of the regulatory framework, and they should be registered, and they should follow the norms of disclosures in terms of not only going for declaring the bad assets, but also in terms of they should also be put into the context of high capital adequacy norms. So, these were the major recommendation. In terms of financial inclusion, for the first time the committee had given recommendations that we should target the unbanked population, and we should extend the financial services to those populations, and this should be in the form of saving products, insurance product, and inflation protected pension funds. It was also for the first time was recommended that government should go for, if the banks are making losses, then government should go for selling those loss making banks to other PSUs or the strategic investor. But there is one line of caution that if it is a large bank, and if it is the largest bank which is making losses, then we can't sell it to the other public sector bank, because this will create shock, and this shock spillover may have a very negative impact. So, it was decided that we should go for some kind of right issue, and this right issue may create some kind of positive buzz on the balance sheet of the firm. Now, it was also recommended that board should be set up for the public sector banks, so that stronger boards must be recommended for the public sector banks, so that they will have a well diversified board members, and they will also have the members outside, and shareholders will also be given. Free banks, or banks should be allowed to set up ATM branches anywhere, and SEBI will be the sole authority to regulate the trading regulation. So, this was the recommendation. So, overall what we have covered so far is that we talked about the NBFCs, then we talked about the certain reforms measure, and then we discussed also the Raghuram Rajan committee, and this committee had lot to recommend for the India's financial system. After this, we will have some more committees to discuss. Thank you so much.